What is a credit default swap?
A credit default swap is a contract between two people, one of whom is giving insurance to the other that he will be paid in the event that a financial institution or a financial instrument fails.
So it's an insurance contract.
It is an insurance contract, but they've been very careful not to call it that, because if it were insurance, it would be regulated. So they use a magic substitute word called a swap, which by virtue of federal law is deregulated.
So anybody who was nervous about buying these mortgage-backed securities, these CDOs, they would be sold a credit default swap as sort of an insurance policy.
A credit default swap was available to them, marketed to them as a risk-saving device for buying a risky financial instrument.
But there was a problem.
Well, the problem was that if it were insurance, or called what it really is, the person who sold the policy would have to have capital reserves to be able to pay in the case the insurance was called upon or triggered. But because it was a swap and not insurance, there was no requirement that adequate capital reserves be put to the side.
Now, who was selling these credit default swaps?
Bear Stearns was selling them, Lehman Brothers was selling them, AIG was selling them.